Good morning and good afternoon, everyone, and thank you for joining us today. I'm Talia Sessler, Chief Corporate Development and IR Officer, and with me on the call today is Nir Dagan, our Deputy CEO and Head of Finance, and Paz Oz, our recently appointed new CFO, who will be starting her new role effective December 1st, 2025. A few words about Paz. Paz has been an invaluable member of our team since April 2018, having held various senior positions within the company and most recently serving as Vice President and Director of Finance. Her deep understanding of our business, proven financial expertise, and strong leadership capabilities make her the ideal person to lead our finance organization as we continue executing on our long-term growth strategy. I'm confident that Paz will serve the company exceptionally well in this role.
Thank you, Talia. It's a pleasure to be joining today's earnings call. I am very excited to step into my new role as CFO next month, even though I know I have big shoes to fill. Nir has been a tremendous leader at Maxstock, especially within the finance department, but I am confident that myself, along with Ori, Talia, and the rest of the team, is prepared to build on the solid foundation Nir has established. With that, I'll turn the floor over to Nir.
Thanks, Paz. Slide 2. This is our standard disclaimer. I think everyone here is familiar with that. Note that there is a presentation accompanying today's prepared remarks. The slides are available on our IR website. Before I dive into our financial result, I want to take a moment to address my transition. As I announced in September, I will be stepping down from my role as Deputy CEO and Head of Finance at the end of this year, after almost 10 years in Maxstock. I would like to thank Ori Max and David Cohen, the entire Maxstock team, our board of directors, and our shareholder for their tremendous support during almost a decade at the company. Turning now our third quarter performance on slide 3. We are very pleased with our strong operating result in the period, driven by gain across all key metrics. We deliver exceptional third quarter revenue of $399.1 million, representing growth of 7% from the third quarter of 2024. Our top-line performance was driven by a 5% increase in comparable store sales, with our July through October comparable store sales growth accelerating to 5.4%, demonstrating continued momentum in the business. We delivered an outstanding 300 basis points of gross margin expansion in the period to 44.3%, as we continue to capture operational efficiencies and improve supply chain management, as well as the benefit from the strength of the Israeli shekel versus the US dollar and low shipping costs. Going forward, and assuming that the macro environment remains similar to the current situation, I believe that we can achieve gross margin of 43, even 43.5% in the next quarters as well. These factors were the main driver beyond the impressive 220 basis point expansion in adjusted EBITDA margin to 17.4% and our strong adjusted EBITDA growth of 22.6% to $69.3 million in the third quarter. Most importantly, we achieved GAAP net income of $44.9 million, representing growth of 31.1% year over year, with an 11.3% net income margin. Our adjusted EPS grew about 30.3% to $0.29. Turning to slide 4 to look at our third quarter trends over a multi-year period, our revenue has grown consistently with strong momentum since 2022. We expanded gross margin by 420 basis points compared to the third quarter of 2022. Adjusted EBITDA has grown at an impressive 18.3% CAGR, with margin expansion of 300 basis points to 17.4%. Our adjusted EPS has grown 81% since the third quarter of 2022, demonstrating the strength and scalability of our business model. Moving to slide 5, this chart demonstrates the increasing contribution of net income attributed to shareholder, which has grown significantly over the past 3 years, outpacing total net income growth. Our third quarter 2025 adjusted net income attributed to shareholder, which reached almost 41 million, representing 1.8 times growth compared to the third quarter of 2022, and we achieved 90.9% of our adjusted net income attributed to shareholder compared to 83.9% 3 years ago, demonstrating the compounding value creation for our shareholder. On slide 6, our 9 months performance highlighted of revenue of 1.1 billion, representing growth of 7.1% from the same period of 2024. Our top line performance was driven by a 4.1% increase in comparable store sale, with our January through October comparable store sale growth of 4.4%. Like the third quarter, our top line result, combined with strong gross margin expansion, fueled a 180 basis point increase in adjusted EBITDA margin to 16.2% and robust of 20.4% growth in adjusted EBITDA to 173.7 million in the 9 months period. We achieved GAAP net income of 104 million, representing growth of 13% with a 9.7% net income margin, and adjusted EPS growth of 13.5% to 0.67 shekel. Slide 7, comparing the 9-month period of 2025 to longer-term trends on slide 7, our revenue and gross profit performance continue to demonstrate our strong fundamentals. Revenue has grown at a CAGR of 10%, and gross margin have expanded by 400 basis points. 9 months adjusted EBITDA performance shows consistent margin expansion and strong momentum as well. Now I will turn the call back to Talia.
Thank you, Nir. Turning to slide 8, our strategy of profitable growth coupled with disciplined capital allocations results in very strong operating cash flow. Since 2017, we've generated almost 700 million or 668 million shekels in free cash flows and returned approximately 479 million, of course, back to our shareholders through dividends and share buybacks. This includes our recent dividend distribution, and I'm pleased to announce that we've declared and paid 110 million in dividends year to date through November 2025, representing a trailing 12-month dividend yield of approximately 3%. On slide number 9, you can see that we remain in a very strong financial position with net cash of approximately 87 million shekels as of September 30th, 2025. This represents a significant improvement from our net debt position at the end of 2024, demonstrating our strong cash generation capabilities, and that is despite the dividend distribution I just alluded to. With our history of consistent cash generation, we have ample liquidity and financial flexibility to execute upon our growth strategies going forward. And then going to slide number 10 and slide number 11, Looking at our core categories, each delivered solid growth in the 9-month period. Housewares, our largest category, representing 27% of 9-month 2025 revenue, delivered strong 5.5% growth. Party supplies, storage, and consumables, representing 15% of revenue, grew strongly at 12.6%. Toys and baby at 13% of revenue grew 4.4%. Arts and crafts delivered 2.8% growth, and office and school supplies grew 2%. On slide number 12 are other categories, which represented approximately 26% of 9-month 2025 revenue and comprise over 25 subcategories. That category was up 12.5% compared to the same period in 2024. These smaller subcategories continue to scale and provide us with another important top-line growth driver. Our other categories growth this year was led by a gradual transition to direct sales of dry and packaged food, which mainly includes confectionery, sweets, and candy. Alongside the growth of confectionery, we also saw strong growth in the pharmacy and drugstore category and in cleaning products, as well as in outdoor. Turning to slide number 13 to cover some of the relevant KPIs for our store fleet, we continue to deliver solid comparable store sales growth. As Nir mentioned, looking at Q3 2025, we delivered 5% comparable store sales growth, with July through October showing acceleration to 5.4%. Note that this period actually neutralized the timing of the Jewish holiday season. For the 9-month period on slide number 13, we've achieved 4.1% comparable store sales growth, with January through October, again, neutralizing the timing of the holiday season, even stronger at 4.4%. The average basket size for same stores increased 3.9% in Q3 and 3.4% for the 9-month period, which means we also benefited from volume growth of approximately 1% in these periods. Next, on slide 14, you can see that our sales efficiency metric, sales per square meter across all owned stores, including new stores, continues to be strong. This number reflects the revenue per square meter for the first 9 months of the year, normalized on an annual basis. It reflects growth of approximately 3.8% compared to the corresponding period, with sales per square meter of almost 21,000 in annual terms. Shekels, of course. Here too, the average basket size grew at a similar rate of approximately 3%, and in addition, we've achieved a 3% increase in volume growth. Next, on slide 15, as most of you know, store expansion is one of our primary growth drivers. And on slide 15, you can see the evolution of our store base and the significant white space opportunity that still is ahead of us. We have approximately 66.1 thousand net square meters as of September 30th, 2025, and also as of today. And our store count remains stable at 37 owned stores in Israel, which contribute over 90% to our revenue that is driven by owned location. Year to date, we opened one owned Max store in Gedera in February this year with a size of 1,900 net square meters. We closed one owned store in Gush Etzion in March, as it was not meeting our KPIs. And we think that this demonstrates our disciplined approach to maintaining only profitable and high-performing locations. Regarding Portugal, a short update. As of today, our subsidiary in Portugal has terminated all of its contracts with property owners. Also, most of the engagement with company's employees have been concluded. We expect that the process of closing Portugal operation will be completed by year end with relatively negligible costs. Then on slide 16, this year's pace of our store openings was below our long-term target, but we know that the pace of store openings is not always linear. What is important ultimately is that looking ahead, we have 5 signed contracts in the pipeline for the opening of approximately 8,600 net square meters. 4 of these stores, Or Akiva, Beersheva, Adalom, and Gan Yavne, are expected to open during next year, with Or Akiva and Beersheva expected to open in the first half. And then just the back of the envelope calculation, if we take the selling space of those branches, approximately 7,000 net square meters, multiply them by 75%, as it is the sell potential for a new store in the first year. Then multiply it by approximately 20,000 shekels per net square meter. We know that the current figure is actually higher, and divide it by 2, assuming an even distribution of opening dates throughout the year, we get an expected contribution of approximately 50 million shekels next year in terms of revenue contribution. This is just from those stores. Next, on slide 17, you know this slide. Our overall target of opening 3 to 5 stores per year has not changed, and we are also in negotiations for additional branches. Our goal for 2030 remains 110,000 net square meters. Finally, when we analyze what underpins our recent excellent results, there are 5 main drivers. The first one, continued store openings and the resilience we demonstrate in like-for-like sales growth over time, even during challenging periods. The second one, better trading terms with suppliers and greater economies of scale in operations, realized from higher sales volume. The third one, the meaningful gross margin expansion that we've seen and more inventory control through our combined initiative to transition to the central DC in Shomoria, alongside increasing the direct import component from approximately 60% in 2024 to approximately 70% this year. The fourth one, the strengthening of the shekel versus the US dollar and the moderation of shipping costs. Obviously, the macroeconomic environment also contributes to the expansion of gross margin. And finally, as Nir mentioned in more details, our new store opening strategy based on 100% ownership model alongside the specific buyout of minority holdings in some branches ensures that over time, a larger portion of the net profit is attributed to our shareholders. Before we proceed, you can go to the next slide. Even though there's nothing. Before we proceed with the question and answer session, I wanted to warmly thank Nir for his guidance and support over the past 4 years.
Pleasure.
It has been a pleasure working with you, and I wish you all the very best during the next chapter of your life.
Thank you.
I also want to congratulate Paz on her appointment as Chief Financial Officer. It is well deserved, and I look forward to working more closely with you, Paz, in your new role. With that, operator, we are ready to take questions.
Good.
Yes.
The questions.
And, okay.
One Q&A.
Okay. So first, best of luck, Nir.
Thank you.
Welcome, Paz. Can you talk about the health of the Israeli consumer and how that is informing your planning for Q4 and next year? Okay, yes, sure. So I would highlight a few things. First, in terms of the macroeconomic environment, it's pretty good. Inflation is moderating. We are now at 2.5%, which is below the upper ceiling for inflation. Because of the moderation of inflation and because of the strengthening or the strength of the Israeli shekel, it is likely that interest rate will go down. Currently, it is at 4.5%, but it is expected that the governor of the Israeli bank will reduce it sooner rather than later, which will help expand, disposable income for consumers. As you look throughout the year, we see an acceleration of same-store sales growth. So the first quarter was at 3.6% same-store sales growth, then we had 4.2, and now we have 5, and then October is even stronger. So that has been very, very robust and with good momentum. And overall, I think, that the economy has exhibited very strong resilience. The situation is better now, and hopefully will remain so.
In a good position.
Yeah.
Good position.
Yeah. And overall, thinking about Q4, everything that was present at Q3, we expect it to remain. The macroeconomic environment, hopefully, the gross profit is here to stay at least for the next few quarters.
Yeah.
And we see a positive momentum in same store. Anything else? Maybe the chat.
Yes.
Okay.
Right. Please, okay.
Okay, again, best of luck, Nir, and welcome. Okay. Oh, so.
How are you? Stores opening.
Okay. How have your new stores opened in 2024 and 2025 performed versus your expectations?
We must say much better than we expected, actually.
Yes, they're doing way better than we expect. But overall, I can say that it is also a function of the location. So it depends on the location, the mall, whether it's a new one, whether they know us there. But overall, new stores are performing well. In 2024, they performed well above our expectations. And in 2025, they are still
keeping the momentum.
Yeah, they keep the momentum and they're doing very, very well. Anything else? I think we answered both.
So,
okay.
If there are more questions.
Yes, we'll be happy to chat with you to further discuss any questions, anything that you would like us to clarify over Zoom or when we are in the US. In any event, we wish you a pleasant holiday season and a happy Thanksgiving next week. Yeah. That's it's a great time of the year in the US. So happy holidays and speak to you soon.
Thank you.
Thank you.